Greetings, everybody. Greg Sweeney here. Our purpose today is to talk a little bit about the economy and the markets moving forward. But before I kick that off, I wanted to talk about some technical difficulties we had over the last couple of months. We've received some phone calls from you all who are missing the September and October written one-page monthly outlooks. I want to apologize for that right now. We had some technical difficulties getting those posted. Everything should be back ready to go for the November monthly outlooks. So please look for those at the normal scheduled time at on our website. So I apologize for that. So let's kick things off. We'll try and move through this in a timely manner. Of course, we have a challenging environment right now. We have rising prices. We have rising interest rates. We have rising home mortgage rates. We have rising rents. And it's putting more things, whether they're goods or services or housing or apartments, out of the reach of the consumer. At the same time, we're seeing stock markets under pressure. We're seeing bond markets under pressure. Bonds are a little counterintuitive. As interest rates go up, the value of bonds go down. That's the market value of bonds. I will add, though, real quick about bonds. Now is the first time in about 15 years we can actually get a decent yield on bonds. So the environment for bonds for first-time investors looks considerably different than it has over the last 13 to 15 years. But back to what I was on here: declining bond market, declining stock market, rising prices, right? Taken all together, the consumer is more guarded, and they have a little bit of a loss of financial security as they see their 401k balances go down, and the housing prices probably start to go down as well. So the consumer is a little more guarded. Why is all this happening? And the first thing I wanted to address was the Federal Reserve. The Federal Reserve is in a position of raising interest rates because they're trying to curtail the inflationary environment that we see here. As they've stated publicly at their Jackson Hole event, and then at the last month when they increased interest rates 75 basis points to bring the Fed funds rate to 3.25%. Their goal is to get inflation back to 2%. They're saying it's going to take us time to do this. That means inflation or interest rates, at least from their perspective, are going to stay up for a while. They're telling us in advance that there will be sustained below trend economic growth. And that's what happens when interest rates go up. The economy doesn't grow as fast. Consumers don't consume as much. Corporations don't borrow as much to increase supply. The economy tends to slow down. And then what I found most interesting, particularly with the narrative that we see in the media that the Fed is going to engineer a soft landing, that last point, there will be pain for businesses and households. I read between the lines on that, and I say that that's the Fed right there telling us that they're probably not going to be successful about engineering a soft landing. That means there will be some sort of recessionary event. I'll talk about that in a little bit later in this presentation, but I think it's going to be more of a headline than a problem. So why is the Fed increasing the Fed funds rate? Frankly, they're trying to get a hold of the elevated inflationary environment that we have in front of us right now. What the issue here is, inflation that started out as energy inflation and inflation in used cars has really started to spread to other areas of the market. If you look at the last 12 months, you can see that the medical care inflation is going up, other goods and services is going up, new vehicle prices are going up, food's going up, right? So what started out as an energy and used car inflationary environment is now spreading to other areas of the economy. This is what the Fed's trying to get under control, and they're trying to reduce this back down to their 2% inflationary target environment. It's going to take time to do this, as like the Fed said. Our own outlook for inflation is measured on a year-over-year basis. And as of this, this chart says August, and I know a third grader with a crayon could have done better, but this is a 60-year-old with a mouse and different colors. So the third grader with the crayon's a little bit better than me. But be that as it may, I think this gets the point across, and that is as of September, this has got August inflationary environment year over year was 8.3%. As of September, it was 8.2%, so it went down 0.1%. As we look forward, inflation is compared on a year-over-year basis. So let's just catapult forward to August 2023. Do we think inflation is going to be at 8.2%? No, not really. We think catapulting ahead 12 months, we think the overall inflationary environment probably goes to a 4% handle, somewhere in there, give or take a little bit. On the screen here, I'm showing 4.25% is where we're anticipating inflation might be a year from now. We think that's a pretty accurate estimate. We just don't see prices continuing to rise at the rate that we've seen so far. This is a chart I want to make sure everyone sees. This is a chart I call what we remember, what we forgot, and what we didn't know. And first of all, what we remember very attractive returns in the S&P 500. Whether we're thinking about returns from the low of the S&P 500 after the pandemic started to its peak in December of 2021, right? That's a 36% annualized increase in the S&P 500, just a fantastic number, right? We probably remember that, and we're thinking that's normal. And if we don't remember that, maybe we remember a longer period of time from the low after the Great Recession in 2009 to its peak in December of 2021. Maybe we remember that period of time. It's not the 36%, but it's 16%, right? 15.9% return. Okay, that's what we remember, and we think that's the return on the stock market, and it's just not the case. Okay, what we forgot is a period of time, which is the red line on this graph, from the peak after the tech stock bubble in January of 2000. It took until January 2013 for the S&P 500 to sustain a level above where it was at the start of January 2000. Okay, and there were two nearly 50% sell-offs in that period of time, in that 13 years while we were waiting, right? One in the wake of the tech stock bubble, culminating as a low in 2003, and again a low in 2009 after the Great Recession, right? But a full 13 years before the S&P 500 sustained a level above where it was in the early 2000s. And then finally, what we didn't know. The yellow line on there I have drawn from the peak of the tech stock bubble to the current market today. The average return on the stock market is 6.3%, right, over that 20-year period. It's actually long-term. The average return on stocks is 9.5%. And really, that's the message I want to communicate to everybody here. That you're looking at the stock market, even looking at the bond market, right? Set reasonable expectations. Reasonable is not 36% annualized since the low of the pandemic. Reasonable is not even 15 or 16% since the low after the Great Recession, right? Reasonable is 9% return on stocks and 5% on bonds, okay? So as you're looking at your own investment strategy, those are the long-term outlooks that you want to use in terms of market returns. So what we remember, what we forgot, and what we didn't know. So, everyone asks, where's the S&P 500 going? And the reality of it is, I don't know. But this allows me to give you some sort of range as to what might be fair value on the S&P 500. We've got earnings across the top, and we've got multiples vertically down the side. And what this is showing right now is the market expects the S&P 500 to earn about $240 a share this year and trade at a multiple of about 17 times. Right, the prospect of a recession coming up at some point in the next 12 months probably means the S&P 500 doesn't trade at a 17 multiple, maybe 16, maybe 15, maybe even down to 14. But let's just use somewhere around 15 to 16, and let's just say that consumers pull back a little bit, and corporations will probably still be able to meet most of their earnings targets. Yeah, they can cut advertising budgets or capital budgets, right? But let's just say the S&P 500 earnings drifts down to $230 a share from $240 a share, and multiples are somewhere between 15 and 16. It suggests that the S&P 500 is fairly valued somewhere around $34.50 and $36.80. within that range of where it's currently bouncing around. And speaking of bouncing around, I think that's one of the characteristics of the economy right now, or not the economy, the markets really, is no one can get their arms around the economy. And that means that we're seeing excessive volatility, both ups and downs, that are probably with us for a while until we get more definition, until the Fed becomes more settled in their interest rate approach. So getting back to that slide I wanted to talk to you about earlier is a recession and economic slowing. Maybe we don't call it a recession, right? Historically, 2 quarters of declining GDP, which is gross domestic product. For the sake of this presentation, two quarters of economic decline have been labeled a recession, right? There's been some sort of discussion about, the first quarter declining and second quarter declining. That really wasn't a recession. We don't want to label it a recession. Well, it doesn't really matter what we call it. GDP, or gross domestic product, declined, right? The reason it declined, though, is because consumers, after receiving a number of stimulus packages after the pandemic, right? We had the American Recovery Act, we had PPP for businesses, we had the CARES Act. There's one more in there I'm missing, I can't think of right now. But what we know those as are the stimulus checks that went out to consumers. Well, initially consumers saved that money. Their purchases went down. We can see that on the blue line on the screen here. At the start of the pandemic, consumers pulled back their purchases. After the stimulus checks went out and businesses started to reopen, consumers are really good at spending money that they have, and that's why we see the huge increase in economic growth from below 20 trillion at the depth of the pandemic to above $25 trillion most recently here. Historically, GDP growth follows a more stoic line, if you will. It doesn't go up and down like it does. That's that green line I have drawn on there. Long term, it goes up about 3% a year. That's about consistent with our personal incomes going up 3% a year as a whole. And where the economy is probably heading is a GDP of somewhere around 23.5 trillion, which is consistent with where our personal incomes are going back to. So I've got a little yellow star on there, or orange star, whatever color that is, suggesting that GDP, gross domestic product, the economy will be going down. It's probably somewhere close to that green line. I have it a little bit above the green line because in the wake of the inflation, average personal income is up a little bit better than 3%. It's actually about 4.6%. That's pretty normal, right? Employers can't keep up with the inflationary environment, so wage increases tend to lag inflationary increases. But the fact of the matter is, taking a long time to say that I think the slowdown in the economy is more a headline than it is a problem, because the economy really can't grow any more than personal incomes go up. And after those stimulus packages have made their way through the system, it's going to go back to that more normal trend line that we see there, which is the green line. And to the extent it does that, it's just the normal course of business. I just don't see it as another sell-off like we saw after the start of the pandemic, where that blue line dropped materially below the green line. I just see the economy heading back towards the green line and then progressing at a more normal rate from there. The trick in this environment, of course, is to, as I started out to say earlier, reasonable expectations for returns. We're not going to see the 15% or 16% that we saw over the last 13 years. It's going to be more normalized, maybe even a bit below normal for the next maybe 5 years or so. But certainly volatility will be part of the markets moving forward. The economy's shrinking again. I don't see that as a big deal. It's just the normal course of getting back towards personal income, as I mentioned. Interest rates probably remain elevated compared to what we've seen over the last 10 years. Expect to pay more for mortgages if you do find a house that you want to buy. Probably not 7.25% after we move through most of this, but probably not 3% where it was 18 months ago either. the question that no one is asking the Federal Reserve is what happens if the Fed can't get inflation back down to 2%? What if it's 3%? Well, we're probably in a little bit higher interest rate environment as well if they can only get back down to 3%. I think that might be the case, but we don't quite get to 2%. And the reason I say that is because right now we're moving through an inflationary environment that's demand push inflationary environment. But I think that with the rising inflationary environment and salaries that have been increasing at a rate above 3%, which is more of a long-term average, we're going to see a little bit of a wage pull type inflationary environment. So don't be surprised if the Fed doesn't make it all the way back down to a 2% target inflationary environment. Moving forward, best to look at your overall long-term goals rather than trying to time a cyclical environment like we're moving through right now. Keep your eyes focused on the long-term secular environment. As I mentioned at the start, bonds are a better opportunity now than they've been in a long, long time. Probably a much higher prospect of bonds returning 5% on average annualized moving forward from here than it was a year ago. Equity markets probably at or maybe even slightly below normal. Job market environment, right? The market for jobs is going to get a little more challenging as the Fed continues to hike interest rates. Corporations won't be as rapidly hiring employees. So some of that imbalance in the job market probably goes away. And as I mentioned, economic slowing, but more of a headline than it is a problem. More on this to come on our next update. Have a great day, everybody.